Shares of EV maker Lucid are down sharply with its lockup period expiring today, but the rest of the EV space is performing well.
Lucid, which was trading under the name Churchill Capital at the time, soared from $10 to $60 in a couple of weeks. However, as the details of Churchill's special purpose acquisition company SPAC merger were made apparent, the stock's value plummeted by more than half since the companies merged. In today's video, we'll talk about whether or not the Lucid IPO is overhyped and whether or not there are any other factors contributing to the stock's current low price. Stay tuned for that. Welcome back to New Vehicle Media, your go-to channel for EV stock. Quick reminder that subscribing's free and liking the video helps YouTube suggest similar videos. Comments are loved and featured in upcoming videos. LCID CCIV February drop. The CCIV transaction was subjected to tremendous market enthusiasm in early weeks. Before the merger was revealed, the $10 SPAC had risen to over $60. The stock of CCIV was predicted to reach $100 at some point. What was it about the company that made it so unique? And what made the public think it could be worth over $100 per share in a couple of weeks? No one knows. Following the announcement of the merger, the stock price plummeted to the mid-$20 range. It was primarily due to the valuation of Lucid Motors at the time. Due to the fact that it has more money at its disposal, the SPAC favors a lower valuation because it will be able to purchase a larger ownership share in the target company. An increased valuation, which benefits existing shareholders while necessitating a reduced ownership interest transfer to the SPAC, would be preferred by the target company. Lucid gained the upper hand in the discussions as the report spread, and Churchill Capital's stock price rose as a result. On sheer conjecture, investors have flocked to the stock, raising the price of the stock as high as over $65. Lucid might then claim that the company's performance merits a greater valuation by citing increased market activity. Thus, the $24 billion negotiated valuation would appear to be a wonderful deal for Lucid at the expense of Churchill Capital for investors, at least in terms of the deal's overall structure. However, based on the share price of $65 a share, the market capitalization of Lucid was more than $90 billion, which was to say that the stock was vastly overvalued by short-term investors. Lucid suffered as a result of this in the long run. LCID recent performance. In recent weeks, the stock market appears to have adopted a risk-on attitude toward growth stocks once more. Lucid, on the other hand, is a corporation that has failed to catch up with the trends. As investors shift their attention away from LCID and toward other electric vehicle (EV) investments, the company has lost more than 20% of its stock price since its merger. The business revealed intentions to build a performance version of its initial product, the Lucid Air Dream Edition, as well as a long-range version of the product, which may have given investors reason to hope for a relief rally. LCID eventually finished its losing streak on Tuesday, August 24th, but the stock appears to have begun a new one the next day on Wednesday, August 25th, 2021. The LCID stock fell by 4.47% to close at $21.81 at the end of trading. The broader markets were rather quiet, despite the fact that both the S&P 500 and the Nasdaq reached new all-time highs, marking the fifth consecutive session in which both indexes advanced. The electric vehicle industry was mainly flat, with the exception of Tesla, which posted early session gains before a late-day sell-off wiped the majority of those gains by the closing bell. Reasons for current drop. Congress could be held accountable. Traders have been buying EV stocks since President Biden took office, hoping for a greener government policy. Biden's infrastructure package was seen as the game-changer for zero-emissions vehicles. This, however, does not appear to be the case. Currently, only the first 200,000 EVs produced qualify for a $7,500 tax credit. The tax credit is tapered down after 200,000. Only Tesla and General Motors had achieved the ceiling. Thus, upstarts such as Lucid were anticipated to benefit from a favorable tax credit path in the future. Analysts hoped for more generosity with the Biden infrastructure package. Rather than that, the Senate upended and worsened the status quo, at least for Lucid. Senate infrastructure legislation would eliminate the 200,000 EV ceiling. This may sound like a good idea in theory, but it may benefit existing manufacturers who have previously sold EVs. Allowing companies like GM to sell an unlimited number of EVs while still receiving the tax credit and actually made it more difficult for upstarts like Lucid. In the meantime, the bill would limit the tax credit to electric vehicles with a base price of less than $40,000. This would replace the current Lucid Air, which starts at $77,400. Luxury brands like Lucid and most Tesla cars would be excluded from tax benefit. The tax credit would also be limited to those earning under $100,000 annually. In turn, this reduces the potential advantage to EV companies. There is still plenty of time to change the infrastructure package before it's finalized. However, this appears to be a significant blow to Lucid's prospects. Secondly, Wall Street hasn't helped either. No one has yet covered Lucid. Analysts normally pick up coverage a few weeks after the company completes its SPAC transaction. If Wall Street says buy, analyst coverage might boost the stock. No guarantees, but with shares down almost 2/3 from their all-time high, analysts are more likely to start with buys. After all, valuation has risen noticeably. Lucid is still highly prized with 1.6 billion fully diluted shares outstanding. Its market cap is $35 billion. Similar to Lucid, other EV stocks were down on 25th August 2021. Lordstown Motor, Arrival, and Fisker have all seen their shares fall by 3.1%, 3.5%, and 1.4% respectively. The stock of LCID is trading more than 65% below its all-time highs as it battles for support at its long-term 200-day line of support. Although it appears that the stock market is building the right side of a deep foundation, there is no clear buy point in sight. Keep a watch out for the formation of a new base, which would indicate the stock's next purchase opportunity. Conclusion: although LCID stock has recovered somewhat since the merger, it has not yet returned to its pre-merger highs. Instead, the stock has stabilized in a trading range between $20 and $30 per share. That is pretty commendable in the current climate. Bear in mind that other SPACs have been battered, and EV-focused startups are doing particularly poorly. Thus, Lucid is doing well to maintain a price double that of its $10 SPAC offering. Still, shareholders hoping for a recovery to the previous $60 price may have a longer wait. The Biden administration was expected to be a game-changer for startups. The regulatory climate, on the other hand, appears to be significantly less favorable. To be sure, political winds can shift rapidly, but for the time being, it looks like Lucid is stabilizing as a company, especially when Lucid recently announced 2 distinct versions of Lucid. For that, check our previous video, the encrypted 4-finger hints from Lucid Motors revealed. That would be the first link in the description. According to Ramon, Lucid is following Tesla's lead and will eventually become a market leader. What are your thoughts? Is Lucid capable of competing with the greats? Let us know in the comments section. That should wrap things up for today. Keep in mind that subscribing is still free and liking helps YouTube recognize your preferences. Thanks for taking the time to watch, and I look forward to seeing you in the next one.